as an investor, you're not necessarily saving on fees or getting different return rates than all the other people who are going into the deal directly, because obviously we're taking our fees out. Most of the benefit that you're getting is having the advice from us and choosing the best deal and organizing it for you and making those recommendations, conducting all that due diligence, sourcing the best opportunities. And then the other thing you mentioned was being able to come in with lower dollar amounts, having the whole thing administered for you. We also negotiate extra time to participate in the deal. And yeah, you're also an extra arm's length away from the actual deal itself. So you're more anonymous to any creditors.
Sure.
You're listening to the Accredited Investors Only podcast, presented by Accredited Life.
All right, Elijah, welcome to the show. How are you feeling today?
Thanks so much, Peter. I'm great. How are you?
Oh, I'm doing very well. So I'm excited for this interview and happy you're here talking to me. So as I was telling you before, I always like to start the show with the guests introducing themselves. So who are you? What are you doing? Why are you doing it? All that kind of stuff.
Sure. Elijah Brown from GoldHawk Capital. I've been an owner-operator of apartment buildings for about 10 years. And 3 to 4 years ago, I decided I was not interested in operating anymore and decided to just raise capital for other operators. So I started doing that through a fund-of-funds structure where I would get a group of investors together and we'd write one check for someone's deal. And did that for a little while, and I still do that. And more recently, over the past 6 to 12 months, I've been getting into the larger equity placement business where I'm working with some family offices and institutions to try to get some much larger checks for these deals and make money in the form of a referral fee. So that's what I'm doing now, looking to do both businesses under the same roof, and have been working on building out the team for that.
I love it. And yeah, somebody who's a capital raiser at heart, and a big part of my participation in the real estate business over the last 10 years has been raising capital. I love what you're doing there. And, it's funny, as many people as we've interviewed, who have, do multifamily and syndications and things like that. I know some of them are on the fund-to-fund side, but I don't think we've really talked about what that is necessarily. So explain that to the audience, how it works, the benefits of it, all that kind of stuff.
Sure. So these deals that are syndicated and open to retail limited partners with checks as low as $50,000 or $100,000. They offer a certain set of terms for those checks. So sometimes, the operator wants to take 30% of the profits at the end of the deal, or 50% of the profits, and they charge all these different fees. But if you're going to come into that deal with a much larger capital commitment, let's say $1 million instead of their minimum $50,000, you can negotiate better terms. So I'll take $1 million from my pool of investors, and I'll go approach that operator who's got a deal and say, here's $1 million, but instead of your 30% profit split at the end of the deal, we're going to knock that down to 15%. And now you don't have to go out to 20 different people to get $50,000 checks. You can just come to me. I'll make it really easy for you, and you're going to give up some of your profit, your upside in the deal, to me. So that's really like the reason why we do it, is so we can negotiate better terms in the deal. But also, we provide a lot of advice to these investors who, they have full-time jobs. They've got other things going on. They don't have the operational experience. They haven't been doing this for 10 years, and they need someone to essentially point them in the right direction. And it's really hard when you've got all these different sponsors or operators pitching you deals, because they only represent their deal, and of course they're going to say that they're the best ones to go with.
Sure.
You kind of need an objective third party to come in and analyze all the deals that are available and advise those investors on which ones they should put their money into. So at GoldHawk, we're looking at almost 100 deals a month. These are operators that have a property that's under contract, and they essentially need equity investment, and so they send us their deals every single month. And I have a team of two people, essentially, and myself, and we go through all those deals and we do due diligence and we analyze them and we follow up and we decide, out of the 100 we get a month, maybe 3 or 4 a year we'll actually pursue for a direct investment with a fund of funds. And so my investors know that I'm only sharing with them the best of the best, the top 1%, the top 0.5% of everything that's coming through in the market. So that's the other thing that's really valuable.
Yeah, and there's so much to dig into there, and something you mentioned in the beginning was kind of getting more involved in the family office side and working with maybe some private equity firms and things like that, and allocating capital with them. That model, that fund of funds model, that kind of capital allocation model is very common in that business, right? Because and it always boggles my mind that they do that. But I think a lot of retail investors think they have to do these things on their own. You know what I mean? Which is funny because, to your point, I think it's hard. It's just like if you're not doing that stuff full time, and I mean, if you're not doing it, looking at deals consistently, it's like, how do you know what to look for? I mean, how do you know how to really properly due diligence and analyze and be able to find, what things are kind of maybe just marketing or kind of hopes and dreams than they are reality. You know what I mean? So what's the kind of the differences that you see with the way that the family offices and those types of investors operate versus how you see a lot of retail operators kind of manage their funds and that kind of thing?
Yeah, I mean, these guys have been doing it for a long time. It's really nothing new. It's like all this hype of fund of funds that's going around on LinkedIn and the social media channels. It's like it's not new. This has been happening for a long time. And these guys have been looking at deals and creating special purpose entities for a long time to come into deals, to bring partners into deals and stuff. In terms of the difference between what essentially they're looking for and what the less sophisticated, more retail type of capital is looking at, they're really focused on experience of whoever's doing the day-to-day operations. Like, that's the most important part.
Mm-hmm.
So, because you can get into a deal that has poor economics, but if it's with a really competent operator, it could be saved. But if you get into a deal with really good economics with a poor operator who doesn't have the experience, it could easily go downhill. So the most important thing that these more sophisticated investors look for is who's running the project. Have they done this, 20 or 30 times successfully before? For us, we usually will engage an operator once they've completed 5 full cycle exits. That's like our gauge of knowing if they have been around long enough to do the thing and know how to do the thing again. So that's the first thing, experience. The second thing they focus on is the basis and the basis in that market. It's as simple as saying, like, are we overpaying for this or are we getting a good deal? So it's really, really simple. The longer I do this, like, the more simple it gets. There's all these metrics you can look at. It's really just like, is the purchase price appropriate for this building, the building age, the location, the market, is the basis good? So that's like the second thing. And then the third thing they look for is yield. So what is the yield looking like when we first buy it? In terms of the cash flow, like, is there enough margin of safety in there to make the mortgage payment and distribute some cash flow to the investors? It's really, really that simple. And then once the operator, the day-to-day guy, has done his business plan, raised the rents, done the renovations, whatever they want to do, what does that stabilized cash flow look like? Is that going to provide, after the mortgage is paid, is that going to provide enough cash flow to the investors to beat the opportunity cost of investing in something else? It's really that simple. It's like, can we hit like 8% investor cash flow after the stabilization? So it's like really, really simple. Operator experience, purchase price, and yield. Are the most important things.
Love it. I love breaking things down into their most simple form. I think a lot of times with like social media and content, you have to really get crazy, and like it get really complicated and complex. And I think some people feel, they feel smarter the bigger words they throw around and stuff like that. But I'm one to kind of lean on fundamentals, and it's just it's hitting those free throws, right? It's practicing layups, it's running, it's all the basic stuff that's going to get you to success at the end of the day. Um, so are you primarily looking in multifamily? Like when you engage with investors, do you want to engage with somebody that believes in the multifamily side, wants to be in the multifamily side, or is it more about understanding what it is they're looking for and then going and placing money and looking for deals in other asset classes and things like that? Or do you have a pretty strict, kind of buy box in the sense that you want multifamily that looks like this and is in this location, or what does that look like?
We decided, or I decided, to focus very exclusively and intensely on multifamily. When I got started with investing 10 years ago in real estate, my whole thesis was the one thing people need the most, besides water, is shelter. And the majority of the population is looking for some affordable type of that shelter.
Yeah.
And really the only solution here is apartment buildings, market rate apartment buildings, affordable apartment buildings, perhaps mobile homes, perhaps other types of maybe single family even. But essentially we got good at operating and analyzing multifamily buildings, and over the past 10 years we've just been really, really focusing on that, and not even development projects. That's too crazy, too risky. Can't wrap my head around those. We're really just focusing on buying existing properties and either doing some minor operational improvements or doing, value add renovations and raising rents. So that's like
Mhm.
the thing we focus on. And this is like our expertise. So when we talk to investors, we're like, if you want to invest in retail or office, I can provide advice, but what we really know the most about and the deal flow that we are generating is apartment buildings. So if you're interested in investing in apartment buildings, we are seeing more deal flow or equity requests in that sector
Yeah.
than anyone else in America. So we can provide you with good recommendations for multifamily.
Yeah, I love that focus, and I know investors certainly appreciate that focus. Um, God, I have a couple questions for you. There's I'm trying to think. There's so many different ways I feel like we could steer the conversation. You know what I mean? And I'm trying to. I'm thinking of the audience in mind too. There's always questions that I want to personally ask because I have to remember who the audience is and that kind of stuff. But what would you say? I mean, I think one of the things that this isn't necessarily like a fund of funds in the sense that you're a fund investing in other funds. It sounds like you're investing in individual deals, right? You know what I mean? So
Yeah,
is it
fund
an
of funds is the
SPV that
wrong
you create or?
Yeah, fund of funds is the wrong word for it.
Yeah.
It's really a syndicate of syndicate,
Yeah.
or
Yeah.
some people call it a feeder fund, but it's not. It's not really a fund.
It's
It's
not a
just
fund. Yeah. Yeah.
yeah.
And now is an SPV or is
Yes,
that what
it's
you
a
say? Okay.
special purpose
Yeah.
vehicle or special purpose entity. What that means is like you're putting money into an LLC bank account to be used for a special purpose, one
Hmm.
use. So
Yeah.
we're aggregating a bunch of funds from friends, family, and investors, and then using that one LLC bank account to make an investment, the target investment in the target company,
Hmm.
um, and it's really just a single purpose entity. Yeah.
Yeah. Yeah. Now it has a private placement memorandum, I'm assuming for
Yeah.
your, yeah. Yeah.
It depends on the
Deals.
deal. So if you're
Okay.
dealing with securities and your deal is subject to securities regulation, that is requiring of an exemption, of course,
Mhm.
then we go down the whole route of being compliant with the SEC, which includes a disclosure of the risks that's included in the private placement memorandum. But for deals where we're not dealing with securities, you really just need an operating agreement. Essentially, it's like think about a joint venture with
Mhm.
three parties. They're all actively participating. No one's a passive investor. That's like what makes something a security and subject to SEC is if it's a passive investment. So when you
Yeah.
have three people get together and they're all playing a role, and that role is clearly outlined in the operating agreement. You don't have to find an exemption with the SEC. You don't have to deal with the SEC. It's the same with like debt products. You're working with a lender. You don't need to go like put together,
Sure.
exemption or SEC filing for that. It really only comes into play when you're working with passive investors, which we do. So for all of our feeder funds or SPVs or fund of funds that they're small enough where we are able to apply for an exemption from SEC filing, even though we're working with passive investors. And so we usually fall under Regulation D, and we use Rule 506B or C, but for most part it's 506B, because that type of exemption allows us to bring in a certain number of non-accredited investors. These are less wealthy people who want to participate in the deals.
Mm-hmm. Gotcha. One of the things I think you hear, like an objection that you hear commonly with like fund of funds and these types of structures is like a double carry, right? It's a double fees, that kind of thing. And you answered. I mean, I in some cases I think it's worthy, because I think people just go to kind of the top, syndications out there, and they don't do a whole lot of due diligence, and they're just, it's a way to allocate a minimum investment of 100 grand or 250 grand or something like that. But that's not everything. I mean, there's a lot of value that you could add, and you've mentioned a few of them here already. But like, I just wanted to throw that question out there, because I think it's a short-sighted way of looking at it. I mean, there's definitely instances where I think some of those people where they're not really adding much value other than the fact that you could put in 25,000 instead of 250 or something. But there's all these other things that go along with it. You mentioned them, but I just wanted to throw that question out.
You have to add a lot of value. But don't be fooled. There are double fees. You're getting the special purpose entity is getting charged fees by the sponsor. Now those fees might be reduced by half because we're negotiating with them.
Mm-hmm.
That's how we're building a lot of the value. But then we also, as organizers of this special purpose vehicle, have to get paid as well. And so we're also charging fees. One thing that GoldHawk has done that kind of differentiates ourselves from just about every single other fund of funds type of group is that we don't do a second waterfall, as in like the operator is going to take 30% of the profits. We're not also going to come in there and take 30% of the profits.
Okay.
We structure our fees as more of transactional fees, because we're not the ones responsible for the performance of the property. The operator is. We're not the ones that are acquiring the property. The operator is. So the way we structure our fees is there is a due diligence fee on the front end. And that covers all the work that goes into analyzing the deal, conducting a ton of due diligence for the investors, and putting together our underwriting models and doing checklists and all kinds of follow-up and everything like that. So there's a due diligence fee. It's not an acquisition fee. And then at the end of the deal, we do an exit fee, like a transaction-based exit fee, as in like we just managed this opportunity for you guys. We weren't the ones who put in all the effort into making the property profitable and great, and so we're not participating in the profit split. We're just going to charge a fixed percentage fee at the end of the deal as like here, we did our job, we managed the transaction, here's our transaction-based compensation.
What does that look like? So that's a percentage based on what?
Yeah, it changes based on the deal. Honestly, based on how much work is going to be involved and how much work goes into it. The way that it usually works out is the investors, it's like almost the equivalent of the investors getting an 80-20 split at the end of the deal. The investors get 80%, we get 20. That's usually roughly how it works out. So as an investor, you're not necessarily saving on fees or getting different return rates than all the other people who are going into the deal directly, because obviously we're taking our fees out. Most of the benefit that you're getting is having the advice from us and choosing the best deal and organizing it for you and making those recommendations, conducting all that due diligence, sourcing the best opportunities. And And then the other thing you mentioned was being able to come in with lower dollar amounts, having the whole thing administered for you. We also negotiate extra time to participate in the deal. And yeah, you're also an extra arm's length away from the actual deal itself. So you're more anonymous to any creditors.
Sure.
So yeah, there's a whole bunch of different reasons why people would want to invest in our pool versus going directly to the operator. One of the other things that we're able to provide value with is we maintain strong relationships with these operators because we bring them so much money. And so, like if you're going into a deal with $50,000 and they're raising $10 million, you're nothing. They're not going to respond. They don't care. But if you're putting in $1 million, you get, a phone number that you can text and call whenever and get an answer immediately. And so a lot of times we have leverage over these operators to get what we want, on behalf of our investors, and that's valuable.
100%. The checks have a voice, and the larger the check is, the larger the voice is. And I've seen some of these kind of institutional allocators where they're funding 100% of the LP side of the deal. I mean, they'll tell you when to sell. You know what I mean? Like they'll tell you when to refi. I mean, they have a very, very large voice, and I love that. I love that strategy. I mean, to be able to have that kind of control over the deal, and then but also leverage that operator's local experience, operation experience, all that kind of stuff. What would you say is your long-term goal there? Would you like to do something like that? I mean, where you can, control the whole LP side of the deal and have that kind of control, or obviously that's going to restrict what kind of deals you could do and the ability of capital raising you have, all that kind of stuff. But I'm curious to what you see is like the long-term strategy here.
Well, once your commitment in a deal is a certain percentage of the overall capital raise, you don't just want to be a passive limited partner in the deal. You want to exercise like significant managerial control over the major decisions. So that's when, like, and we're starting to do this now, where like if we come into the deal with a meaningful portion of the capital, we want to be a co-GP, a co-manager in the deal with decision-making rights. So I see this as moving in the direction of, GoldHawk comes into deals as co-GPs, brings 5 million, 10 million or whatever into the deals. And this is our direct investment platform where, we have a discretionary fund at some point, maybe with a couple $100 million in it, and we're selectively joining deals as co-GPs with manager rights. And then the other side of the business is the making referrals to large check writers. That's something we'd like to do as well, essentially being like a boutique real estate investment bank where we're kind of managing and arranging the entire transaction.
Yeah.
Yeah.
Yeah, that's another. I think that's a good way of thinking about it, and you said this before. It's like this isn't a new model. It's gotten like a lot of play over the last few years. I think since COVID, when people were home and looking for something to do, a lot of them found their way into raising capital. And I think it's almost in some ways become like the new fix and flip. It used to be a time when you go to like a weekend seminar at a local hotel and learn how to fix and flip properties, or you go to like a conference, or you're out to dinner or something. You get in an Uber, and the Uber driver's fixing and flipping properties and all.
Sure.
In the last few years, it's been like now your Uber driver is a fund to funds manager. You know what I mean? He went to the old, he stayed at a Motel 6 last night, and now he can, manage funds. And it's become a very kind of crowded space, and you hear some horror stories and things like that. And I think at least for the investors, there's questions to be asked, right, on your experience, all that kind of stuff. And I love your background as an operator, and some of the things you were saying about, what you look for. Would you say there's anything, what are some things that you do from a due diligence perspective that is different than what the average, individual investor is going to do on their own? Obviously knowing that some of them do very, very little, and then others do more, you know what I mean? But I feel like a lot of times investors don't really want to spend any money on due diligence, which boggles my mind. It's like, the amount of people that want to have an attorney review docs and things, it's so little. And it's like, if that's $1,000 to review, or even, a few $1,000s to review, it's like, I don't know if, I mean, I would help me sleep at night. You know what I mean? So I'm curious to if there's anything you feel like you do that a regular retail investor is not ever going to do.
Yeah, we have a very large due diligence checklist. Keeps getting larger. I don't think I have the new one uploaded, but on our website, I think you go to goldhawk.us/inspection, and you
Hmm.
can download for free an older version of our due diligence. I got to upload it, the new one. But yeah, we there's a ton of things that go into it. First of all, when a deal comes across our desk, my assistant Chelsea, manager of investments, she will make sure that we collect all of the relevant documents that we need to analyze the deal. This includes the pitch deck, the broker's memorandum, the Excel model with the pro forma, the T12 financials, the rent roll, the AR aging report, any appraisals, photos, CapEx plan, literally anything you can imagine. Like we're asking for that up front. And then she'll actually go in and extract about 75 key data points, like metrics, and add it to our pipeline for review.
Hmm.
And then, our that data table does auto calculations with some of the stuff so that we can look at some of those metrics, like, your going in leverage and yield on cost and IRRs and stuff like that. I'll then go in and do kind of a first pass on the deal, and see if it's worth our effort in doing a deeper level of due diligence. And once it is, it then goes over to our analyst, also manager of investments, Jaden, and he'll go into the underwriting model and use his own underwriting model and really like comb through the numbers, the rent assumptions, the growth rate assumptions, all that stuff included in the underwriting, the market, and everything like that. And he'll make a recommendation to me, kind of like an investment memo, on what are the risks here, what are the positives or the negatives, do we want to pursue it or not. And then from there, we start with our our huge due diligence checklist. So it's got a ton of questions on it, like a whole section on the operator's experience. Have they ever lost money? Their net worth, their in-house property management, or how much they charge in property management fees, all kinds of stuff like that. There's the whole legal section. There's a whole cash flow section, a debt section. There's a whole bunch of things we need to understand about the deal to
Hmm.
get comfortable with it. Yeah, there's just a lot that
Yeah,
goes.
I would think you could whittle out 80 to 90% of deals just right there. I mean, because they're just not
Yeah,
going
so we
to.
end up with like
Yeah.
0.5% of the deals we look at, we actually pursue for direct investment. And like 1% of the deals we look at, we share with family offices and institutions.
Hmm. Yeah, makes a lot of sense. I mean, it's just the average operator does not have all that, and they probably wouldn't even want to entertain it. You know what I mean? Necessarily. Whereas the people that know what they're doing, that stuff's pretty accessible, right? I mean, they're used to that kind of stuff, especially if they want to raise real capital. Because like you said, there's benefits to working with somebody like you versus them having to go out and do all that themselves, and there's a cost associated with that as well. So. Um, Interesting. Well, I want to be respectful of your time. I know you got big things to do, places to be, so I really appreciate this conversation and sharing the insight. If people want to learn more about what you're doing, you mentioned the checklist you have and stuff like that. How can they learn more and get involved and get in your radar?
Yeah, our website, goldhawk.us. And here's another free resource for limited partners that kind of want to be able to quickly calculate the most important metrics when they're looking at a deal to invest in, and that's goldhawk.us/LP calculator. So that's another thing that you guys can download for free, that should help out with trying to analyze deals. Yeah, all the information's on the website. You're welcome to reach out and contact us from there. I'm on LinkedIn, Elijah W. Brown on LinkedIn. So send me a connection request and a message. And yeah, hopefully you like my content. Appreciate it.
Awesome, Elijah. Thank you so much for being here.
Yeah, thanks so much, Peter. Appreciate it.